Hello, this is Dave Shepson. I am an accountant and professor and have done a series of videos to help you with different accounting concepts. This is the second part of a series of videos about financial statements. If you watched the first part, hopefully you got the basics about what the different statements are, what they're about, what kind of information they give us. And this video is going to be a little bit more about what do we do with them. So this is what I like to call the fun part. This is the point we get to and why we have the statements in the first place. So think of the financial statements as a group, kind of like a GPS system, only we're going to sort of work it backwards. You usually use GPS to find out where you are and plug in a destination and figure out how to get there. We're kind of gonna work that backwards from the way you would use a GPS. And so the point on the map where you currently are, that's really what your balance sheet represents. It's your position. Again, it's also called the statement of financial position. It tells you exactly what you have at this point in time. And so it's really answering the question, where am I? Then we need to figure out how we got there. Our other statements will answer that question for us. Primarily, but not only, our income statement and statement of cash flows. That shows us the route going backwards, how it is we arrived at where we currently are. And of course, this can be used to work the other direction and do future planning. And that's a different area of accounting that's outside of what this video is talking about. But those other statements explain how we got there. The balance sheet, again, tells us where we are. And as a whole, we really get a good picture of where we are. So what do they tell us? I'm going to take the statements one by one and give us some examples of the kind of information we can get from them, besides what might be just most obvious. And this is really just an introduction. There's a whole area of accounting that deals with this in managerial accounting, and you'll learn a lot more about that in the future. But all the statements cover a few basic areas, and some emphasize certain areas more than others. So profitability is one of the issues that we want to look at, and some statements tell us a lot about profitability. For example, the income statement is primarily focused on profitability. Our gross profit is a picture of our profit potential, and our net income is our actual net profit when everything is done. And then we also have the issue of efficiency. A lot of statements will give us clues about the efficiency of an operation. And the income statement is also very heavily a reflection of efficiency. The more efficient you are in your management and your operations and managing your costs, and even in the marketing side and sales cycle, the higher your net income is going to be. So in some ways, these two are very much connected. Some might also tell us what kind of position we're in, and really the income statement does not really answer this particular issue for us. And then some will tell us what direction we're headed, or what direction a particular aspect of our business is headed. And the income statement doesn't necessarily answer this, but if you have income statements for several consecutive periods side by side, then you can get very much a sense of the direction of the efficiency and profitability of the company. I'm going to show you just one example of a way that certain information can be pulled from a financial statement to give us a more clear picture or answer a very specific question. And so I'm going to show you a ratio that is often used that is called the gross profit percentage. And the gross profit percentage comes from gross profit. We have that number there. And we want to see the relationship between that and our sales. And so if we divide the gross profit by our net sales, and I just multiply it by 100 to make it a percentage, this tells us how much of every dollar of sales is then available for our operating expenses and hopefully a profit when we're all done. And this is very important information to know. We might set targets for what this percentage should be, and it can definitely have a direct impact on our net income when all is said and done. And it also helps us evaluate how we're doing when we have an increase or decrease in the dollar amount of our sales. The dollar amounts can be deceiving, but if we're maintaining a good gross profit percentage, that's helpful to know if we're hitting what our target should be for that. Now we're going to look at the other major statements. The balance sheet is probably the biggest one, and also the statement of owner's equity. And let me just talk to you briefly about those four issues. Profitability is shown in a couple of ways here, more so on the statement of owner's equity, because what we're seeing there is the way our equity changed and why. Well, we can see that our net income or our profit was the major contributing factor to our increase in equity for that period. On the balance sheet, you're not normally going to see much about profitability, with the exception of this. If you were looking at a corporate balance sheet, this is for a sole proprietor, but a corporate balance sheet in the equity section has more and different equity accounts. So it might have common stock, and then it'll have an account, a special equity account called retained earnings. And that is what retained earnings represents, is the prior profits of the company that have not been distributed out to shareholders. And so we can't tell how many different accounting periods it took to get whatever balance is in retained earnings, but we can see some history of profitability or lack of profitability on a balance sheet, at least for a corporate entity. Again, efficiency is really only going to be seen in terms of our net income, but the balance sheet primarily tells us about our position, our financial position. And I'm going to show you an example of how it gives us some very helpful information about that. And again, we don't necessarily see much about direction. You do see what direction equity is going based on the most recent performance, but you don't really see much about direction unless you were to put balance sheets from prior dates, side by side, so you could see how maybe assets is changing or how liabilities is changing, things like that. So I'm going to show you one example of how certain information can be yanked out of this report and used to answer a very specific question. And a lot of people might be interested in something called a cash ratio. And as you could probably guess, one of the major components of this is cash. The cash ratio is trying to answer the question, what is this company's ability to pay its short-term obligations, things that it has to pay within a year or less, with cash? So it excludes all of our other current assets. It just uses cash, and it compares those to what is referred to as current liabilities. These are liabilities that are due within a year. So those are my two components, and the formula is just to divide cash by the total of current liabilities. And that 1.56 that you see there, what that simply means is that for every dollar of debt that is owed to somebody within a year, I've got $1.56 sitting in cash available to pay that. Very helpful for me to know, and perhaps helpful for a supplier who might want to work on credit, or an investor, or certainly internally for a manager to know what our cash ratio is. Next, we're going to look at a statement of cash flows, and we looked at this a little bit in the last video, but I want to highlight a couple of things that can jump out. Again, the things we're trying to pay attention to is what can these statements tell us about profitability, efficiency, our position, or direction. This one is primarily about our cash position and direction. You do kind of infer profitability because the cash flows from operating activities is a function of profitability. That doesn't really happen typically without profitability. And it does tell us a little bit about efficiency in terms of how efficiently we're using cash. We could kind of analyze this in a little more depth than we're going to do in this video to get at how efficient is our cash handling. Primarily, it tells us about our cash position, what it was, what it is at the end of the period, and how much it changed and why, what was contributing to increase or decrease in our cash balance. and inherent in that is the direction our cash is going. And so a couple of key insights you might look at from this is we did not have a very large increase in cash, but we had a substantial output because we had a purchase of equipment, and then we had a whole lot of financing related outputs. And so our cash from operations more than offset that, but the net effect was not very big. And a purchase of equipment is not normally something that happens every month, so that may help us interpret, what we're looking at here. Is this typical? Is this an unusual event? That kind of thing. Next, we're going to look at who might use these statements and why, and a little bit of how. You have external users, people outside of a company who might want to look at your financial statements. Certainly, if you have an IRA or a 401k and you're getting perhaps investment advice from an advisor, and they are relying on the advice of analysts who are directly analyzing financial statements of your company and a bunch of other companies, you may not be doing it directly, but you are relying on these kinds of analysis for investment decisions. We have credit and lending decisions, which might be suppliers or service providers who are determining whether they want to take a risk of working with you not on a cash basis, but on a basis where they invoice you. And so they might analyze your position, your performance. Certainly banks for giving loans are going to do that. And then we have mergers and acquisitions. One of the ways to eliminate competition is to buy it, and it seems to be the American way since the 80s especially. And so analyzing a company that might be in a position for an easy takeover, or at what price you would buy them that would make sense, those kind of things, you're going to do an analysis of their financial statements. And companies will tend to also compare their own performance against industry leaders. That's known as benchmarking, or look at the statements of their competitors and just for competitive analysis, especially if you're in the same industry. Management is really, we're talking internal here, the inner workings of a company, and management decisions are for the improvement of the company itself, its position, and its performance. So the statements are going to give us clues about areas to improve or weaknesses we may have. They can also show us strengths that we could leverage. For example, if we're in a very strong cash position, we may be one of those companies wanting to look at an acquisition of a competitor. Or if you have a lower cost structure for your product than a competitor, you have a more gross profit built in, you might undercut your competitor in price and still be able to maintain a good overall profit margin and get more market share that way. Those would be examples of leveraging a strength that you have identified. And then the other side is you're going to do the same thing. You're going to do benchmarking and be looking at your competitors as well against your own performance. And all of these things together help us set what our operational priorities need to be. They're not the only inputs into what our operational priorities are, but they do definitely speak to that issue. And if you have a good CEO, they are hopefully listening to their CFO, Chief Financial Officer, about these things. Another metaphor or way to think about all of these statements is they provide us with some tools that we can use. And we have a set of diagnostic tools available to us. I'm not going to go into detail about all of these. I've shown you a couple of examples of them, actually. But just like in the medical field, you need multiple measurements to really diagnose what's going on with a person. If you go to the doctor with some symptoms, they're not just going to take your blood pressure and send you off and make a diagnosis. They might do blood work. They're going to weigh you, take your temperature, perhaps do some scans, a variety of things, get a medical history, and they use the context of all of that, the whole picture, to figure out your baseline health and if anything is going on. And it's the same way with financial analysis. The statements are our data. What we do with that data is really diagnosing. So some of the things we do are use ratios. I showed you a couple of examples. The gross profit percentage and the cash ratio are a couple of very common ratios. There are hundreds of ratios. There are variations on ratios, but there's probably about 20 or so that are what I would call bread and butter ratios that are very, very commonly used to look at companies. Then we also can do something called a horizontal analysis, and it's not that complicated. Horizontal, picture a line going straight across, and that's a timeline. A timeline is normally represented by a horizontal line. And that's all it is looking at a particular item or set of items on a financial statement and how it has changed over time with the same company. So we can see what's happening with our profitability or with our assets or with our equity or with certain expense over a period of time. And that shows us trends. A vertical analysis, actually the gross profit percentage is both a ratio and it's part of a vertical analysis. A vertical analysis takes a financial statement and it relates everything on that statement to one key item. And for an income statement, we use net sales as sort of the anchor figure. And we show everything as a percentage of net sales. And so our gross profit percentage is really just one of the items that's compared to net sales. And that gives us different insights, a different kind of insight. And then benchmarking I've alluded to is comparing your statements and even some of these ratios and things to a leader or a competitor. One of the issues you have to remember is that this is a learned skill, and just like someone doesn't read medical textbooks and go to nursing school or go to medical school and then just come out being very effective at diagnosing people, they do a lot of practicums and clinicals, and they have a lot of mentoring that they have to learn how to put that information together and understand it to interpret what's going on. So don't expect that the first time you do this, use these tools, that it's all going to make sense to you and all come together and you're really going to get the picture. The more you do it, the more you'll kind of understand what you're seeing and what they're telling you. And that's the end of our little presentation. I hope it's been helpful to you. There are more videos to come. I've got review videos out there on other basic topics. If you have any special requests, you can certainly request them on the YouTube page. It's David Shepson is the YouTube channel. And anything that will help you with accounting, I'm willing to put out there for you. Thanks for your time.